Hey everyone, welcome back to Corporate Decoder. Today Universal Logistics Holdings, ULH just filed an 8K, and I am seeing a related party transaction that is raising some eyebrows. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is selling two properties to a related party, and the details of this deal are what we need to unpack. Alright, so Universal Logistics Holdings, or ALT as you might know them, has filed this current report and 8K. These filings are usually for big announcements or material events that investors need to know about right away. The main event here is a deal involving a subsidiary of Universal Logistics, UTASI Finance Incorporated. This subsidiary sold a real estate facility in Kearny, New Jersey to a company called Lakeshore Ventures LLC. Now here is where it gets interesting. In exchange for this property, Lakeshore paid UTSI $38 million in cash, subject to some adjustments. But that's not all. Lakeshore also transferred ownership of another company, Passaic Ventures LLC, to UTSI. This Passaic Ventures company owns a real estate facility in Newark, New Jersey. So essentially, UTASI is buying a property in Newark by selling a property in Kearny and getting cash. And the reason why this transaction might be viewed with a bit of scrutiny is that Lakeshore Ventures LLC is affiliated with Matthew T. Moran, who is the chairman of Universal Logistics Holdings, and Matthew J. Moran, who is a director of the company. So we have a transaction between the company and individuals who are in leadership positions. Anytime you see related parties involved in significant deals, it's important to understand the terms and ensure they are fair to all shareholders. The filing does state that this deal was reviewed and approved by board members who are not directly involved or have a conflict of interest in this particular transaction. Including the audit committee, this is a standard safeguarding step for related party transactions to ensure fairness and due diligence. The actual agreements that detail this transaction, the real estate purchase agreement and the membership interest purchase agreement, are filed as exhibits to this report. These are the nitty-gritty legal documents that lay out all the terms and conditions, while we won't dive into every legal clause. These exhibits are crucial for anyone wanting the full picture of the deal. They would contain the specifics of those adjustments, prorations, and credits mentioned earlier. Looking at the overall context, Universal Logistics Holdings is in the industrial sector, specifically trucking, with a market cap around $400 million. They have over 10,000 employees. The company has recently seen some analyst attention with price targets shifting, and it was also dropped from the Russell 2000 Defensive Index in late June. These kinds of property transactions, especially with related parties, are significant for a company like this. It's not just about the cash, but also about how the company is managing its real estate assets and if these transactions are optimizing their operations or simply moving assets around. Now, this filing doesn't give us the financial statements directly, but the sale of assets like these can impact the company's balance sheet and cash flow. Selling a facility for $38 million is a material amount of money for a company of this size. It could be used to pay down debt, invest in new equipment, or return capital to shareholders. The key question is whether this sale represents a strategic move to shed non-core assets or a way to generate liquidity potentially linked to other financial pressures. Considering this is a related party transaction, the transparency and fairness of the deal are paramount. The fact that the disinterested directors and audit committee approved it is a positive sign, but investors will always want to be sure that the company is getting fair market value. Without the audited financials detailing the book value of these properties, it is hard to say definitively if this was a home run deal. However, the acquisition of a second property in exchange for cash and a third property gives it a more complex exchange than a simple sale. What I am actually looking for is how these transactions ultimately benefit the company's long-term strategy and shareholder value. Is this divestment of one property and acquisition of another a strategic realignment of their real estate footprint, or does it signal something else in their operational or financial health? The market will be watching to see how this cash infusion and property exchange play out. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe, and join our Discord in the link below.